Hey everyone, welcome back to Corporate Decoder, the place where we uncork the secrets hidden within those thick financial reports. Today, we're diving into a document from Exchange Listed Funds Trust, specifically their Certified Shareholder Report. Get ready because this one's got some interesting moves in the real estate ETF space that we need to decode. This report, filed with the US Securities and Exchange Commission, is like a yearly checkup for registered investment companies. It tells us what is going on with their investments, how they're performing, and all the nitty-gritty details shareholders need to know. The main star of this report is the Long Pond Real Estate Select ETF, which trades under the ticker symbol LPRE. This is an actively managed exchange traded fund, meaning it is not just blindly following an index. Instead, its managers are picking specific real estate-related companies they believe will do well. Think of it as a curated art collection versus a mass-produced print. So, how did this art collection do from the 3rd of April 2025 to the 31st of August 2025? Since it is a new fund, they are reporting since its start. The Long Pond Real Estate Select ETF saw a total return of positive 12.94% based on its net asset value. That is a pretty solid start for a new fund in a relatively short period. Let's put that into perspective with a hypothetical $10,000 investment. If you had put in $10,000 on the 3rd of April 2025, by the 31st of August 2025, your investment would have grown to $11,294. That is a gain of $1,294. Not too shabby. Now, to see how it's stacked up against the big boys, let's look at its performance compared to the S&P 500 and the MSCI US REIT Index. For the same period, the S&P 500, that broad market index, had a stronger showing with a total return of 20.34%. So, while the Long Pond ETF did well on its own, it actually lagged behind the general stock market. It did significantly outperform the MSCI US REIT Index, which tracks real estate investment trusts, with a return of 5.75%. This tells us that while the broader real estate sector was a bit sluggish, this specific fund managed to pick some winners within that space. Looking at the fund's stats, as of the 31st of August 2025, it had net assets of over $50 million. It held 23 different investments. The total advisory fee paid was about $95,000. And here is an interesting one. The portfolio turnover rate was 85%. A high turnover rate means the fund managers are buying and selling a lot of its holdings. This can sometimes lead to higher trading costs, but it can also mean they are actively managing the portfolio to chase performance or react to market changes. Where is all this money invested? The report breaks down the sector weighting of its investments. A whopping 72.9% is in real estate, which makes sense for a real estate ETF. Consumer discretionary makes up 20.8% and materials is at 5.9%. There is also a small slice of other assets in excess of liabilities at 0.4%, so it is heavily concentrated in real estate as expected. Let's dive into the crown jewels. The top 10 holdings. Independence Realty Trust, Inc. is the biggest with 8.2% of the net assets. Then we have UDR Incorporated at 8.0% and Prologis Incorporated at 7.0%, a core SA and Mid-America apartment communities. Incorporated are both at 6.9%. James Hardie Industries plc is at 5.9%. Taylor Morrison Home Corporation is at 5.7%. Rounding out the top are Invitation Homes Incorporated, First Industrial Realty Trust Incorporated, and Equity Lifestyle Properties Incorporated, all at 5.0%. These are all significant players in the real estate and related industries. Looking at the schedule of investments, it is a deep dive into the specific companies. Under common stocks, we see them holding shares in various real estate titans like Agree Realty Corporation, CBIE Group Incorporated, Equinix Incorporated, and Federal Realty Investment Trust. It also includes companies involved in hospitality and home building, like Hyatt Hotels Corporation and Taylor Morrison Home Corporation. This shows a broad but focused approach within the real estate ecosystem. Interestingly, for the period ended the 31st of August 2025, the report states no material changes occurred. This suggests a period of relative stability in the fund's structure or strategy, at least from a reporting perspective. Now let's touch on some of the operational housekeeping. The audit fees for 2025 were $15,500, and there were $3,500 in tax fees for services like tax return preparation. These are standard costs for a fund. The fund has an audit committee, and they've identified Timothy Jacoby as an audit committee financial expert. This is good to see, as it means there is someone on the committee with a strong financial background overseeing the fund's accounting and auditing. The principal accountant's fees are broken down. For audits, it was $15,500 in 2025. For tax services, it was $3,500 for things like tax return preparation and calculating distributions. There were no audit-related fees or other fees billed beyond these. This indicates a fairly straightforward relationship with their auditor, Cohen and Company, Limited. Let's look at how the fund made and spent money. Total investment income was about $168,000 from dividends and interest. Expenses were around $95,000, mostly advisory fees. This left a net investment income of about $73,000. But the real action was in the net realized gains on investments, which added over $3.1 million. This pushed the total increase in net assets from operations to over $3.2 million. This shows that the fund's performance was largely driven by the appreciation of its holdings, not just the income it generated. Digging into the notes, we learn more about the fund's structure. It is a Delaware statutory trust registered under the Investment Company Act of 1940. It is classified as a non-diversified investment company, meaning it can invest a larger portion of its assets in a smaller number of companies. This can amplify both gains and losses. The fund commenced operations on the 3rd of April 2025, so this is its first full reporting period. The report explains how they value their investments, which is crucial for calculating net asset value. They generally use market valuations, but if those aren't readily available or don't reflect fair value, they use other methods. This is where things can get a bit subjective, and it is important for investors to understand that fair value isn't always the exact price you'll get if you sell immediately. Most of their investments, the common stocks, are classified as level 1 in the fair value hierarchy, meaning they have quoted prices in active markets. This is a good sign that valuations are based on observable market data. The fund works with several service providers. Exchange Traded Concepts, LLC is the investment advisor, and they receive a fee of 1.00% of average daily net assets. Long Pond Capital LP is the sub-advisor, making the actual investment decisions. Foreside Fund Services, LLC is the distributor. Ultimus Fund Solutions, LLC handles administration and fund accounting, and Brown Brothers Harriman and Company is the custodian and transfer agent. It is important to note that the advisor pays many of these fees, which simplifies things for the fund itself. Now let's talk about the risks, because no investment is without them. The report highlights market risk, which is the general risk that the entire market could go down. There is non-diversification risk, meaning if a few key holdings falter, it can significantly impact the fund. Trading risk is also mentioned, pointing out that ETF share prices can trade at a premium or discount to their net asset value. And crucially, there is real estate sector risk, which means the fund is exposed to all the ups and downs of the real estate market, including property values, interest rates, and economic conditions affecting occupancy and rents. This report also includes a detailed discussion about why the Board of Trustees approved the investment advisory and sub-advisory agreements. They looked at the nature and quality of services provided by Exchange Traded Concepts and Long Pond Capital. They compared the fees to similar funds, considering the costs and potential profits for the service providers. They also looked at economies of scale, though for a new fund, this is more of a future consideration. Ultimately, the board concluded that the agreements were fair and reasonable for the fund and its shareholders. So, what is our assessment of the Long Pond Real Estate Select ETF based on this report? Well, the fund has gotten off to a promising start. With a solid return since its inception, it seems to be effectively identifying promising real estate, related companies outperforming its REIT benchmark. The concentration in real estate is a double-edged sword. It means they can really capitalize on a real estate upswing, but it also exposes them to significant sector. Specific downturns, the active management approach, and relatively high portfolio turnover suggest the managers are actively trying to find opportunities, but this also comes with higher potential trading costs and risks if their bets don't pay off. The advisory fee of 1.00% annual rate is also something to keep an eye on. Especially when compared to passive index ETFs, it is a reasonable fee for active management, but investors need to be sure the performance justifies it. The overall financial health looks good for the period, with net assets growing and investment gains driving performance. The fact that it is a non-diversified fund means it can be more volatile than broader market ETFs. But that is a trade-off for potentially higher returns if the chosen sectors and companies perform exceptionally well. The key takeaway here is that this is a specialized ETF for investors bullish on the real estate economy and who trust the active management of Long Pond Capital. If you are looking for broad market exposure, this might not be it. But if you believe in their strategy and are willing to accept the sector, specific risks, and higher turnover, it presents an interesting opportunity in the real estate investment landscape. Alright, that is our deep dive into the Long Pond Real Estate Select ETF's latest report. What is your take on their performance and strategy? Do you think their active management approach will continue to pay off, or would you stick with broader market ETFs? Let us know in the comments below if you found this breakdown valuable. Don't forget to hit that like button and subscribe for more corporate decodes. And as always, join the conversation and connect with fellow finance enthusiasts in our Discord community. The link is in the description. Thanks for watching, and we'll catch you in the next one.